Welcome to this lesson. In this lesson, I'm going to talk to you about a concept that I call the Capital Continuum. And you'll see that it's actually, these slides are from a presentation that I did all the way back in 2015 for a local incubator here in my hometown. The idea is I want you to understand the timing of when and where to raise capital and which type of investor is appropriate for the phase that you're in. So, a typical timeline of the various types of investors and or lenders that you could go to for capital is here in front of you. And it starts on the left. If you remember, I've referred to the FF&F group before to you, and that would be family, friends, and founders. And that would be that group. That's sort of the initial group. We talked about the idea of you providing your own capital along the way and possibly even talking to your network of family and friends to put some investment into your business. From there, you usually graduate on to an individual angel investor or a group of angel investors. From there, you might accomplish some milestones and be ready for a larger investment group, typically venture capitalists. And then down the road, you may look to lenders. There are instances where lenders will provide startup capital, but they're few and far between. That's called venture debt. It has happened even at an organization I was at. We had a program called the Line 12 Fund, and it provided venture debt to idea only stage businesses. So it does happen, but it's not very common, and that's why I don't spend too much time on it. As we go through this, you'll see here in the middle this little arrow and an equal sign. What I'm suggesting there is to move to the next stage, you've accomplished some significant milestones in the form of revenue, issued patents, things that we talked about in a previous lesson. The biggest takeaway I want you to get from this Capital Continuum presentation is the difference between how these investors look at opportunities. And you'll see I've drawn a line here down the middle. And on the left side, I say that they are futuristic focused. And on the right side, I say that they are historically focused with your information. What you need to understand is that line could move a little bit left or right, but for the most part, this is true. For the most part, investors that are on the left side of this slide will be focused on the things that you say you're going to do, the things that you say you're going to accomplish, and the way in which you validate those ideas and prove the assumptions that you're making. The folks on the right side of the page are going to be more historically focused. What have you already accomplished? Not what will you do, but what have you accomplished? And the reason this distinction is important is because if you are approaching someone who is on the right side of this page, specifically lenders, and they are very historical focused, yet you don't have a whole lot of historical data to provide them, particularly in terms of existing revenue, then you're going after the wrong investors. So remember, this group on the left side is typically very futuristic focused. On the right side, they're very historical focused. So I mentioned the Line 12 Fund. This is back from when I was chief lending officer at a financial institution, and we inserted right where that arrow was. It was capital before angel investors and right after the founders had put some of their own money into the program. So some of that capital does exist, but again, loans are not that common. Those were actually small dollar loans that were backed by the SBA because of the program and the way in which we rolled it out. So the key to landing capital in this capital continuum is knowing your target audience. And so I'm going to run you through a bunch of slides that show other sources of capital, whether they be angel investors, venture capitalists, or those types of things. And I'm going to talk about them in terms of the normal size deal during that phase, how tough it is to obtain that kind of money, at least based on experience and people that I've worked with, and how long it can take to do it. So if you're providing skin in the game, meaning you're investing in your own idea, it's not a very sophisticated deal. It's pretty straightforward. I've seen with startup founders it range, and I have seen them put hundreds of thousands of dollars into deals. But for the most case, we're looking at anywhere up to $25,000 just to get the ball rolling, to incorporate the business with an attorney, to have a logo made, to have a website put up, those kinds of things. How hard is it to get money at this type of capital? Should be pretty easy because you just have to look in the mirror and decide if you're willing to invest in yourself. And of course, because of that, it can be instantaneous. So when we get to the FF and F round, the other founders, not including you, but the other founders, your family and friends, it's not a very sophisticated deal. You're not looking at all kinds of due diligence. You're not looking at all kinds of term sheets. You still should treat them like an investor and do a pitch to them, and not just assume because they're your mother or father that you can just ask for money. Treat them like any other investor. So it's a moderately easy deal in terms of sophistication. Somewhere around $0 to $50,000 is about the norm that I've seen. This would be called, maybe your seed money when it comes from the first person outside the founders. It's not too difficult to obtain, assuming that your family or friends have the kind of money to invest. If they don't, then obviously it can be really difficult. And that is what a lot of people run into in this category. Remember that this group typically invests in you, not the idea. Okay. They invest in you because they trust you and they like you. They're not investing because they think it's an amazing idea. I've heard of very few parents who will look their kid in the face and say, that's a terrible idea. You shouldn't do that. Okay. So, and then this can also be pretty instantaneous. It doesn't take a lot of time to get this kind of deal done. As I said, you should treat them as investors and run them through your pitch deck and, treat them just like anyone else, but it can be pretty quick to get a check cut from this group. Crowdfunding is another source of capital, and these are moderately sophisticated deals just because you can't take them lightheartedly and you have to structure how you're going to do it. Remember, there's two ways: to provide them equity or to pre-sale your product, and the preferred method is I'm going to pause and see if you remember, it's not equity, it's to pre-sale. Remember, angel investors and other investors down the line don't love when you've given up equity through a crowdfunding campaign. The typical funding amount, if you're doing a pre-sale, is the purchase price of the item times the number of customers. And the average I have seen per some reports is up to $10,000. So let's think about this. If the average crowdfunded deal that actually closes and hits its mark is $10,000, you're not going to be raising a substantial amount in many instances. Certainly some have gone on and even raised hundreds of thousands. It's moderately difficult to raise money through crowdfunding. So you might even say it's really difficult. And the reason is because it takes a lot of creativity to stand out. Because there's no barrier to entry to submitting a campaign on places like Kickstarter, it's pretty easy. You just create a video and stand up the idea and talk about what you're doing. And then those campaigns tend to run 30 to 60 days. There are microfunds out there. I mentioned the one that I used to run as a chief lending officer of a financial institution. We actually won national awards for that microfund, but there are others out there and you can search for them. They're pretty easy to get money from, meaning you just have to have good personal credit and be able to submit a good business plan and have some good experience and be willing to say that you'll pay the loan off if if the business can't afford it. Some financial institutions have micro funds that also provide money in exchange for equity. So you can research those as well. Typically, we're talking about a few hundred to $25,000. For example, the SBA's micro fund will go up to 50. And then it's moderately difficult to obtain because, again, in this instance, they're betting on you, not the idea. And it can take less than 30 days. I do get asked about grants quite a bit, and they do exist out there, but frankly, they're few and far between for startups. Really, when it comes to startups and grants, what you're looking at is what is called our SBIR and STTRs. That's not a topic for this course, but I'll just say that you can research those acronyms, and those are usually for companies that are applying for research grants behind science-based projects that the government is funding. They're moderately difficult in terms of the sophistication. You have to write a very detailed business plan to apply for them, but they can be up to millions of dollars depending on the phase you're in. And they're extremely difficult in terms of obtaining because you're competing against a lot of people for the grant money, and they can take many months to apply for. We talked about pitch competitions before. They're not overly sophisticated. You just have to be willing to create a pitch deck and then stand up there and do a good job presenting it. Go back and revisit the lesson on pitch decks if you're confused about that. Usually the amount of funding you're going to get through a competition is just winning some money, some support, some legal dollars and things like that. And it ranges from a few thousand to $25,000 or more in some instances. It's moderately difficult to obtain because you're in a competition. Usually what we will see is either one winner gets the money or the top three get some money. It's not very common for everyone that pitches to get capital. And it can take a few weeks to a few months depending on the schedule of the pitch competition. Strategic partnerships are a great way to raise money for your startup. by going and finding someone who's in business that has a synergistic business with yours and wants to partner with you. But they can be difficult to land because it involves typically a lot of legal work. You're looking at anywhere between $5,000 and $100,000 in capital, and they can be fairly sophisticated and difficult to obtain because a lot of people are trying to partner with businesses that are already successful. So you're looking at many months to negotiate these types of deals. All right, we've talked about these guys before, so we're starting to get into the meat of where startup capital typically comes from. Angel investors are individual or groups of well-to-do professionals that like to invest in startups. They're somewhat sophisticated deals because they're smart people. They're going to ask you key questions, and there may be some legal documents involved. You're looking at anywhere between $50,000 to $2 million. They can be difficult to obtain. I've told you before that the rule is pitch 100 and get one investor. And on this slide, I actually said back in 2015, you're looking at 6 to 12 months to accomplish. It's probably more like 3 to 6 months these days if you're doing it right. And most of that difference in time between what I used to say and what I say now is because there have been some documents that are published out on the internet that are free resources for startups trying to raise money. They try and simplify the legal document portion. So venture capitalists is when you start to get into extremely sophisticated deals. These are folks who do this for a living. And so these are sophisticated investors. They have sophisticated deals and they have sophisticated structures to their deals in many instances. Here, you're not looking at just a couple of $100,000. You're usually raising millions, if not hundreds of millions of dollars, depending on the phase you're in. And they can be really difficult to land. The further you get up this chain, this capital continuum, it gets harder and harder to get capital from people. And with VCs, you're pretty much getting to the top. So it can take years to obtain VC money. The reason I say that is because you're typically, again, remember, we're moving through the capital continuum, starting at the bottom with the FF&F group, then angel investors, then venture capitalists. It's taking time. You're accomplishing milestones. And so by the time you get to venture capitalists, you've been at it for years. There are alternative finance companies out there who can help you, but these are typically loans. Maybe you have some purchase orders that you've already landed as a milestone for your startup, but you haven't collected on those yet. You could sell those to an alternative finance company and they will give you money in exchange for those purchase orders. They're just going to take a percentage away from it. So the way those work is it's often a percentage of the revenue. They're not very sophisticated. It's pretty straightforward, but remember, it is very much a bit of a loan. And so they're only moderately difficult to obtain. You just have to prove that you have cash flow coming in, and that's where your purchase orders or maybe even your credit card advances come in handy. And so because they're not too difficult and not too sophisticated, they can happen in less than a month. Now we're talking about lenders. And again, it does happen for startups, but I just want to cover this with you on the basic level. They're not very complicated. The essential, go check out my course, The Complete Guide to Business Loans. I talk exactly about how this works, but in short, what you need to be able to do is climb three big hurdles, right? The first is called the ability to repay. Show that you have cash flow coming in, that you can make the payment on the loan, whether that be personal income or business income. Then show that you have some sort of collateral available, whether that's equipment or real estate, or maybe even just your personal signature as collateral for a small dollar loan. And then lastly, show that you've got some liquidity on hand, meaning you have some cash. You have some emergency reserves to fall back on in case the business doesn't do well. Those are kind of your three big hurdles. It's definitely more in detail than that to work with a lender. And again, I cover that in my other Udemy course on that topic. It's actually my most popular course right now. And typical funding amounts for lenders, particularly with newer businesses, is anywhere between $50,000 and $350,000. And they can be difficult to obtain because you got to be able to climb those three hurdles. And there's not that many startups that I've met that can really do it. And then finally, it can take a couple months. It can be really quick if there's no collateral involved. But if you have collateral that you're offering, like particularly real estate, they're going to have to do an appraisal on that. And that could take a couple of months to accomplish. So know that lenders are an option for a source of capital. I just wanted to cover that for you today as part of this particular lesson. But as the overall course, when you're thinking about working with startups, remember that lenders give a loan in exchange for a payment back to them that includes principal and interest, whereas investors are giving you money and they typically don't get their money back until you've had an exit.